Aaron thought he had it all figured out. He put 20% down, locked his rate, and fired his landlord. Looking at this chart, you can see his logic. His $2,000 rent compared closely to his new $2,020 mortgage. Close enough, he figured. Then there's his coworker Scott. Scott hates renting, so he skipped the research and bought the biggest house the bank would approve. Scott pays $3,800 a month, assuming he's building equity. He isn't. $3,400 of that vanishes immediately into taxes, interest, and upkeep. Scott acted on impulse, and Aaron played by the book. Yet despite their different approaches, both men walked directly into the exact same financial trap. The mistake happens the moment buyers compare a monthly mortgage to monthly rent. That calculation is mathematically incomplete. It ignores the underlying costs that actually dictate whether a property makes you richer or poorer. Because of those hidden costs, Aaron's proudest achievement, his $80,000 down payment, is the lowest yielding asset in his entire portfolio. Signing a 30-year loan based on a simple monthly payment comparison means you are crossing a false finish line. You haven't even seen the actual race. To see where the money actually goes, we have to crack open Aaron's very first monthly payment. Look at his $2,020 payment. Only $289 buys a sliver of his house. The remaining $1,733 goes straight to the bank. This is amortization. That massive chunk is pure interest. It vanishes exactly like rent. When we map this chart over Aaron's first 5 years, he builds a mere $20,000 in equity, while handing the bank over $100,000 in unrecoverable interest. For the first decade of a 30-year mortgage, you aren't really buying a house. You are renting money from a bank, and interest is just one piece of the unrecoverable expenses. There are other monthly costs that never build a single dollar of equity. Add in property tax, homeowner's insurance, and routine maintenance. Historically, financial planners bundled these together into the 5% rule, representing the true yearly cost of keeping the structure standing. But that rule was built for an era of 3% mortgages. Today's 6.5% interest rates have essentially doubled the cost of capital. Watch this formula update. That 5% variable is replaced by 7%. Multiply your home's total price by 7%. Divide by 12, and you have your true, modern, unrecoverable monthly cost. Relying on outdated benchmarks in a high-rate environment makes buying look artificially affordable. Let's go back to Aaron's $80,000 down payment. He thinks it's a growing asset, but historically, housing beats inflation by only 1 to 2% a year. Compare that flat housing return to an index fund averaging 7%. Over 5 years, $80,000 in the market grows to $112,000. That $32,000 gap is his opportunity cost, the growth forfeited by trapping cash in drywall. Because there's no monthly statement for money you didn't make, this invisible opportunity cost is the most expensive mistake in the entire transaction. Looking at both scenarios across the first 5 years, we can see exactly how the numbers have shifted for modern buyers. Scott sets $3,400 on fire every month pretending to invest, while Aaron locks his cash into a slow-growth asset with high overhead. For Aaron and Scott, the math suggests that the financial security they were promised isn't guaranteed by the deed alone. Reaching the actual financial finish line requires calculating your true unrecoverable costs and your opportunity costs long before you sign the closing papers. Because if you don't do the hidden math, you aren't securing your financial future. You're just trading a landlord for a bank.
We are taught from a very young age that renting is just throwing money away, and that buying a home is the ultimate financial milestone. But assuming a mortgage automatically builds wealth is a trap that catches millions of people. Take Scott. He hated the idea of paying for nothing, so he scraped together all the cash he had to escape his $2,000 a month apartment. He stretched his finances to put 10% down on a $475,000 house. That single decision to put down less than 20% triggers a mandatory penalty fee most buyers ignore: private mortgage insurance. Scott pays an extra $200 a month purely for the privilege of borrowing more than the bank thinks he should. Ultimately, it protects the lender, not him. This bar chart breaks down his new $3,800 monthly payment, and the reality is ugly. Right off the top, $2,300 evaporates as interest, and $200 goes to that mortgage insurance. He actually builds under $400 of equity. Over 5 years, he'll hand the bank nearly $135,000 in interest alone. Now watch what happens when we compare those new losses to his old apartment. The irony here is thick. Scott left because he felt like he was throwing money away. Now he sets roughly $3,400 on fire every single month in pure unrecoverable costs. That is significantly more than his entire previous rent. Calling it a mortgage provides a sense of pride, but the math reveals a different reality. Scott is paying significantly more in unrecoverable costs than he ever did as a renter. Without running these numbers, a buyer is often just paying for the illusion of ownership. The path to buying a home is paved with incentives that stay mostly invisible to the average buyer until they've already signed the paperwork. Start with the lender. When they tell you what you're pre-approved for, you hear a safe shopping budget. It's actually a ceiling, the absolute most they will let you borrow. Since they earn more interest on a bigger loan, their incentive is to set that number high and let you anchor your expectations to it. Then there's the buyer's agent. They are paid a percentage of the purchase price. If you spend more, they earn more. Telling a client they could probably stretch a little is never neutral advice when the person saying it profits from the stretch. Underneath all of this runs the oldest psychological pressure in the market. Buy now or be priced out forever. It weaponizes urgency, and the fear that makes you rush is the exact same fear that makes you overpay. These pressures combine to create an environment where overextending your finances is the default outcome, ensuring the industry extracts the maximum possible capital from every transaction. Let's put real numbers on the table and track 3 people with the exact same starting capital over a 5-year timeline. After 5 years, Scott is dead last. He bought the most house, but he's buried in interest and mortgage insurance with almost zero equity to show for nearly $200,000 in monthly payments. Next is Aaron, who bought responsibly and did everything right. He steadily accumulated about $20,000 in equity, and his home saw a modest 1% annual appreciation, bringing its value up to roughly $420,000. This line graph tracks Aaron's equity growth. He looks great on paper, right up until he decides to move and hits the transaction friction of real estate. Selling costs eat up roughly 6% of the home's value, about $25,000. That cannibalizes almost all his gains. Zooming in, Aaron walks away with $95,000. But remember, he originally put in $92,000 for his down payment and closing costs. 5 years of building equity netted from around $3,600. Finally, we have the third subject, the one everyone felt sorry for. She kept renting her apartment for $2,000 a month, but instead of buying, she took the $92,000 she would have spent on a down payment and closing costs, and she immediately put it into the market at a conservative 7% return. She also took the $800 difference between her rent and Aaron's higher cost of owning and strictly invested that into the market every single month. This side-by-side chart compares their final liquid net worth. 5 years later, the renter is sitting on roughly $190,000. She essentially doubled Aaron's total net worth, and she can sell any share of it in a single day. By consistently investing the difference and avoiding transaction fees, the renter used compound interest to outperform the housing market's hidden costs. This outcome shows that the assumption of renting as a financial loss only holds true if you ignore the math. There is one crucial catch. The renter only beats the buyer if she actually puts her savings to work. If that money just funds a nicer lifestyle, renting loses. This spectrum measures the price-to-rent ratio. It immediately reveals which side of the bet your specific market is on. Take the price of a home and divide it by the annual rent for a comparable place. Under 15, the market favors buyers. 16 to 20 leans toward renting. 21 or higher, renting clearly wins. Next, check the adjusted 5% rule. Multiply the home's price by current interest rates, let's say around 6% right now, and divide by 12. That gives you your true monthly cost of owning before any equity. If you can rent a similar place for less than that number, renting is mathematically cheaper. Third is the break-even horizon. Because it costs roughly 3% to buy a house and 6% to sell it, you usually don't beat renting until you've stayed somewhere between 4 and 6 years. If you aren't sure you're staying that long, you will likely lose money on the sale. Finally, you have to invest the gap. The math only works if you treat the difference between renting and buying as a mandatory, non-negotiable payment into your investment accounts. You have to treat it like a mortgage payment you didn't make.
Sometimes the math will tell you to buy, and a home can be a wonderful thing to own. Stability, control, and a place that's yours are real benefits, and they are entirely valid reasons to purchase real estate. But you have to decouple your emotional desire for a home from your financial planning. Run these specific numbers for your situation before you sign any contracts. Aaron measured equity when he should have measured total wealth. Scott measured pride when he should have measured math. True financial independence requires knowing the difference between a lifestyle purchase and a wealth machine. The best defense against an extractive market is putting down the cultural myths and trusting the math.